bring in David Bianco. It'll be a success. Come on here, David, and thank you for giving me those 200 LinkedIn shares. I really liked them. Who gets the shares at Bank of America Merrill Lynch?
Our best clients.
Your best clients get them. There's a process.
Of course.
And it's like a fair distribution. Is it a different distribution than 10 or 20 years ago when there was a fever?
It's not a process that I'm very close to, actually.
Yes,
Strictly on the research side. But of course, there's a process, and it's a fair one. And there's a lot of demand for these recent issuances.
You got out of that nicely. I go over here to the screen. IBM price to sales 2.10. Victor, dive right in here. It's a little itty bitty number, folks. 2.10%. LNKD equity BQ 15.01 is the price to sales they've got up here. What does a normal guy like you think of a valuation like that?
Well, price to sales isn't my favorite valuation metric, Tom, but I look at a name like IBM. I see a company that's still growing very well internationally. Tech in general, exposed to the global economy and business spending. I look at PEs. They're more comparable across industries and sectors. Companies like this with low double-digit PEs, 12, 13, 14 PEs, I think the growth potential is underestimated.
Full disclosure, I read their whole annual report this year. What a model of what to do with cash. Are there many IBMs out there, or is it a rare thing?
Well, that's a good point. I mean, there are a lot of things that I'm very happy about what the non-financial companies have done, the way they've navigated the recession, the way they've taken advantage of global growth. Technology companies in particular, operationally, they're performing very well. Balance sheet-wise, dividend policy, I think there's a lot of criticism to be put toward a lot of non-financial and particular tech companies. IBM's doing some good stuff, but I'd like to see the dividend payouts go up a lot at tech.
All these distractions to what most people want to know is, should I be in the stock market? Dreaded first chart. Bring it up here, David. You'll see it down here. Oh, it's a wonderful S&P. Of course, I took out the crisis. I took out the drop. It's just one big bull market. Is this bull market going to continue?
Well, I do think during May, June, and probably even past the 4th of July holiday that the market's range-bound, 1,300 to 1,400 on the S&P. During that time, investor focus, I think, will be on key things like oil prices, interest rates, the dollar. If interest rates stay benign, between a 3-4% range, as my colleagues expect after QE ends, and oil prices have peaked, then I think the stock market's going to rally strongly in the second half of the year.
Let's talk to one of your colleagues, Priya Misra, with us today. Earlier on Bloomberg Surveillance on Radio, 7 to 10 a.m., Priya Misra of Shop Bianco. I asked her how Fed actions have affected the equity markets.
Right.
I would say in the U.S. at least that the Fed on hold almost helps stimulate the stock market some more because it's arguing for continued policy accommodation. It's suggesting that the Fed is evaluating inflation risk as well as growth risk.
Priya Misra there. David Bianco, relatively cautious outlook economically, relatively low interest rates. Why is that good for the stock market?
Well, a couple of things. I think quantitative easing minimized deflation risk, which was good for risk assets in general. But the stock market's up for a lot more reasons than just QE. We've had great earnings performance because of global growth, strong commodities and capital goods demand, business spending, et cetera. Now, I think a lot of investors are concerned that given the expansion of the government's debt, they want to see what happens to long-term interest rates once the Fed steps aside from purchase. Our view is rates are not going to go up much, as my good colleague Priya Misra believes, and I believe that too. Once we get some more proof that long-term interest rates are going to stay benign, that I think is going to set the stage for a strong market rally via PE expansion.
Two charts here. I want to show this chart. Folks, we can't make money in the stock market. It's been a malaise. It's been a terrible decade. Okay, I cherry-picked Danaher, DHR. Bianco suggests industrials. The industrials have really moved with Danaher maybe leading the way. Look at that rocket ship. That looks like Colgate. That's remarkable. Why industrials now?
Well, industrials and technology. And I want to remind you that we did reduce our allocation to industrials from overweight to equal weight on Monday. Still like the sector a lot. Move certain groups like machinery from over to equal weight for the time being. It's very tactical. But what you see at both tech and industrials is heavy international exposure, heavy business spending exposure. And we think not only will corporates spend more money on technology, we see companies, we see energy, utilities, mining companies ramping ramping up their CapEx, really good for industrial
CapEx
businesses.
comes in. Elgin, chart 1, this is the same stock, Danaher, but we overlaid dog of dog Intel. Bianco likes Intel. You like IBM. I mean, there's two different stories there normalized back 20 years, isn't there?
Yeah, and I think,
Break exclusive, I made David Bianco speechless. I mean, how does Intel get it going?
I mean, they're different businesses, obviously.
Yes.
But I think what's overlooked, we're neutral on Intel, but Intel is one of our 10 tech titans. We like that group a lot. I think what's underappreciated about Intel is that chip demand, particularly chips used in servers, that demand is strong. So it may be the case that PCs are growing at a slower pace than tablets, but chip demand in servers is growing strongly.
What's
They
another
dominate
tech
that.
titan? Just give us a name besides IBM.
A lot of the usual suspects: Apple, Google, IBM, Oracle, Qualcomm, Intel. Right down the line.
I didn't hear you. You didn't say Cisco.
They're in it too. Hewlett-Packard and Cisco, part of the.
Just buy them all. Buy all tech.
I think that's the thing.
They're going to go up in what? Global GDP?
They are mostly driven by global GDP and business spending within that. So when you look in whether it be U.S. or European GDP accounts, look for business spending.
Okay, I want to pause here. You are an equity strategy. You're in this every day. When you see a LinkedIn, you look across a balance sheet, an income statement, a cash flow statement. There's like a leap of faith. We're going to talk with Pim Fox later. eBay went up like a moonshot and it stayed flat for X number of years. It's only 18% above its recent peak after its IPO. How do you analyze across accounting the hopes and prayers of any given company in Silicon Valley?
Well, the short answer is you have to try to quantify the expectations, sensitivity test them in a DCF model. And there are certain companies out there that are growth stars and the valuations are demanding, and you really need to do the analysis carefully in a DCF context. But I would say when you look at the S&P more broadly, growth stocks are underappreciated in the sense that I don't think they're getting any credit for their ability to replicate their businesses abroad and continue to get good returns on capital. There are some criticisms to be had about. I think these tech companies need to raise their dividends, need to do some share repurchases. There's a lot of demand for corporate debt out there. These companies can issue debt and recycle that money by buying equities, buying back their shares. But when I look at large S&P constituents, the premium for growth stocks is amongst the smallest premiums we've seen in decades. Now, there are certain star stocks and growth stories out there that have higher, more demanding valuations, but that's really the exception.
Do you believe in price to sales analysis?
No. I think price to sales is a poor metric. I mean, the sales don't belong to financial claim holders, so it doesn't account for different degrees of leveraging across businesses. Companies have very different margins. I prefer to look at DCF models, and if I'm using a thumb nail metric, PE.
Great. David, thank you so much.